All right, so stocks kind of showed some resilience today. Very small range, very small volume. Had some pretty negative news overnight to give us a reason, a catalyst to have more of a sell-off than we did. In fact, one headline I saw was that stocks were plunging overnight. So I don't know necessarily if we are plunging, which again is the problem we have with our financial media that are looking for clicks, right? So the headlines have to drive clicks instead of actually reflect the facts of the actual what's going on. But it was a pretty resilient day nonetheless. We were able to hold up, and our leadership was able to hold up. And it was a little bit of a risk-off day, but we've had a pretty good start to the week in terms of risk appetite. So not a bad thing to get a little bit of a pause. It's hard to keep strongly going up for too long. The longer we do, the harder it is to maintain. So we're going to break down our expectations again with that in mind. We're also going to take a look at a stock that's in a sector that's been kind of lagging, underperforming. We wonder how to trade that kind of sector. So we'll talk about how with our trade idea of the day. So let's go ahead and get started. Today is Wednesday, July the 22nd, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As always, you can see strong bullish posture with the intermediate line up above 80, above its market sentiment line. Very, very strong moves here. You can see that the near-term line remains in the at least in the upper half of the chart, and it's only 6 days, so it's not like we've been on this near-term run forever. The typical range is 7 to 12 days when you're on a strong bullish rally. We talked in our technical analysis class on Friday about this idea that while this wasn't an intermediate pullback because we only dropped 23% here, it looks very characteristic of one. And in today's class, we went back and we looked at all these other moves off of big low points. And I won't go too much into that. You can check it out. All of our archives are listed on our calendar on our website, and all of our subscribers get access to all of our classes and all of our, except for the two Q&A sessions. That's only for our premium subscribers. But they get access to all the other trading rooms and all the archives. So I will just say that this pattern is very similar to what we've seen before, and it's playing out. So what this little, again, while not necessarily a pullback per se, it has a lot of characteristics of one, as I mentioned today. So while I don't think we'll get a 1 to 3 month intermediate rally off of this, because we did not get an intermediate line drop below 50, I do think that we might get a little bit longer run than what we had expected, potentially up to at least these old highs where the Qs have already gotten to. The Nasdaq, in fact, has gotten up through it, and then of course you can see like the Russell 2000 still got a long ways to go just to even get to the 78% retracement, much less through that and start to retest these highs. And you can see it's just now getting back up to its market sentiment line, and it actually did get an intermediate pullback in terms of getting the dark pink shading. It didn't quite get a red line. That combination of dark pink shading and a red line is technically what constitutes an intermediate pullback, as well as like I said before, a drop. Now this one did drop below the 23% retracement. So again, lots of characteristics. The problem is the Nasdaq, right? The Nasdaq has avoided the U.S. markets being in a bear market, like all the other foreign markets since that peak on January of 2018. And now with this little sideways action that we've had since June into early July, again, the bullishness in the Nasdaq is really kind of masked what was probably an intermediate pullback. It just didn't drop as much because the Nasdaq didn't drop hardly at all. So, and we're back up. So we're, again, I think we're going to get another 3 month run. That would be like a 6 month run. That would be insane, and that would be the pullback on that would be tremendous. Something that nobody would be able to handle comfortably. I don't think that's the case, but getting a 1 month run and potentially a couple more weeks out of this, I can definitely see something like that happening. And I can also see too this near term, like again, a typical near term run, 7 to 12 days on a good bullish trend. You know, that's kind of where we're at right now. The momentum line has fallen down here. At one point, kind of flirting with a bullish confirmation signal. In fact, during our class today, it was flirting with that. Obviously, we finished up off the lows of the day, and you know, very neutral momentum line. Doesn't really matter when it's in this middle area. So good, strong, bullish posture. The Dow's intermediate line has crossed. Well, actually, it's sitting right on top. As you can see, these two numbers right here, sitting right on top of its rising market sentiment line. The Nasdaq hasn't gotten back above its yet. So again, it kind of shows that we're not nearly as over bought as we think we are. And then finally, and it is a sign of weakness for the intermediate line to be below, as you can see some of these others. And then finally, the Russell 2000 is also still below its market sentiment line, even though both are rising. So you would expect the intermediate line, which moves faster, to eclipse it and potentially get back up into the reversal zone like what we see on the S&P. And if for that to happen, it would have to take a pretty decent move. In fact, here I've got to activate that and bring this back down to that high point. It would have to make a pretty decent move back to its 0% line, which is on that 78% retracement, and then move on. You can see we kind of held the 23% retracement level during this pullback here, and we didn't quite get to the 38% there, but it's held to 23% here, and it's bounced back up, and like I said, pretty decent chance we can move up towards these old high points. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us here on YouTube. That will notify you when these videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, that you want us to do another video again tomorrow. If you like our videos, you want to tell us, click that thumbs up. You can do that right now while you're watching. If you don't like our videos, of course, you don't have to click on anything. Two, while you're down there, comment. What did you get out of our videos today? What questions or comments do you have? Post those in the comment section down below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow us on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our blog here, of course you can check out some of these other things on our site, including the Market Outlook live video. Every day I do the Market Outlook. I also do a live video at 3:30 Eastern Time, where we put on today's trade idea, as well as we look at all the other trades that we've done. We manage them all the way up to the time that we close them as part of our class portfolio that we use in our trading rooms. So if that's something that interests you, and I know it does, it interests a lot of you, because that was like one of the most highly requested features that I've gotten for that, then you can check that out there. Again, that's available for all of our subscribers, our plus, our monthly subscribers, which are our plus subscribers, as well as our premium subscribers. Also check out our other classes right here. Click on this heart that opens up this new window. Hit that like button right there. Click on the thumbs up. It takes you to your Facebook page. Where you can click on this like button right here as well. Again, the more you do that, that benefits us, because the more likes and engagements these posts have, our Market Outlook posts have, the more Twitter and Facebook will promote our content to all of our followers, even if they're not logged on to their accounts at the time that we post these. It also benefits you, because the Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it very easy for you to engage with us here. All right, let's get back to the charts here. Let's take a look at the S&P on the long term. Again, we're now a few more days. We're closing above last week's high in the Heikin Ashi. That's significant. That's how bullish we are so far this week. Higher high, no lower shadow, above a rising 50-day moving average. The PPO is still rising. So very good, strong momentum right now all across the board. The Dow is getting us a golden cross here. Not quite as bullish with the close, but still, and we're not quite getting a higher high. Same thing with the Nasdaq. You can see it's kind of slowing down a little bit, showing a little sign of weakness there with the lower high. and a slightly higher close. But the Russell is giving us a higher high and a good strong bullish close and a good bullish candle that can lead to its own golden cross pattern. So, good strong patterns here that give us some potential in the long term, even if there might be some weakness in the short term, some potential for a long term pretty decent move going forward. Of course, looking at the 3 green arrow chart for any kind of weakness in the short term, we still got 3 green arrows, so we're still riding a good strong pattern here, riding up above the 8-day moving average, right? Before you get, really before you get any kind of weakness, you'd have to break the 17 and stay down below that. And you can see even here we spent a few days below that before we pop back up on the S&P 500. So we're rising above an 8-day moving average. The 8-day is pulling away from the 17 at a nice steady clip according to the MACD. They're both above their 30-day moving average. Stochastics is in the upper reversal zone. Buyers showing control, strong control there. So there's not a whole, all these patterns. Look at the RSI, and we're above 60 on the RSI. Look at the DMI. And your ADX is rising. We're not quite above 30. We're at least we're above 25 and below 20. We're not close to the end of a trend at all here, which again gives us some opportunity. And then the Bollinger Bands, we're still in the upper quartile here, strong Bollinger Band position, well above the value area of this volume profile, and just a nice strong move. Let's get rid of this one here. Let me get rid of that alert. That was for last month's inventory. So, nice strong move here to the upside. In fact, I can activate this and move this now up to this high point. Nice strong move to the upside, and we're kind of flirting with breaking above the value area. So that's where the high point is, and you can see once you get above, and we're kind of clearing this volume node here, once you get above the value area, there's very little resistance to the upside. As you can see with the Qs, very little resistance once you get above the value area. Lots of easy moves to the upside. And then if you look at IWM, we're just now clearing the point of control. So it's still got some room to run just to get to its value area, which includes this high. So there's not very much room above its one. Most of its move outside the value area was to the downside. So it's really lagging, but also shows again the lack of being significantly overbought. Like there's a function to this rally of just bouncing off an extreme oversold condition, and now we're kind of transitioning towards now a bullish trend that we're still taking some time to work our way through because we got all this volume still above us. We made that transition on the Qs because we cleared all that volume here easily. But we're not quite there on the IWM, which is a little bit more indicative of kind of the broader economy as a whole than the Qs are. All right, now let's take a look at the intraday charts, and you can see, we're flirting with the 4-week high point. We're not even getting a near-term pullback yet. We're at the high of the near-term run so far. You can kind of see if we were to pull back, we've got a lot of volume below us, so it's not going to just fall off a cliff from here. So good strong moves on an intraday basis. Today's volume in trading range, the range was below average. The volume was way below average too. Those were actually good numbers. It does slow things down a little bit, but if you look at these averages, they're falling, and there's still a lot of, according to this chart, there's still a lot of room to fall for the ATR. It's still pretty high, which means there's still some good again, we haven't really established a bullish trend yet because we haven't fallen below this. Another positive development is if and when we ever do get this intermediate pullback, is the volatility is really low. Like it's dropped to almost extreme lows. Like we're below the 85% mark. We're headed towards 80%, even though we're still in the low 20s. In fact, kind of in the mid 20s. Which means at some point in time, because the VIX is still high, that there's going to be a bounce up into the 30s, maybe even up to 40 if we get a full 38% retracement. But even just a 23% retracement, you're looking for a move into the 30s to get, and this will probably just get at the most back up to the 95% mark. That's a very good sign because that means VIX isn't going to go haywire again and suggest that any kind of noise will be more than just noise or more than just a pullback. And we're not looking for like a market sentiment pullback or a death cross anytime soon in the S&P 500. All right, before we dive into what's driving this market and our trade idea today, just to summarize our technical outlook here, we still got the strong bullish posture. There's more likely going to be some kind of noise or maybe even an intermediate pullback here in the short term, but nothing that will change this what is now not just an oversold technical bounce, but now we are kind of establishing ourselves on a bullish trend going forward from here. So again, that doesn't mean that we won't have the down days, and on the down days, the market's not going to turn into a recession or bear markets. We're not getting this huge rotation into these other areas. That will come later towards the end of a mature long-term trend. As of now, we know what our leadership is, as you see here in a second, and we'll continue to ride that leadership as the market moves higher, even with its near-term pullbacks and even with its occasional intermediate pullback. Which might be coming sooner rather than later. But, you know, there's also some arguments to be made that we've had an intermediate pullback that was kind of masked by the strength in the Qs, which continues to mask any kind of weakness, underlying weakness we've had in equities as a whole, and not just this basket of highly valued, large market, mega cap, large cap tech names. So what do you think? Do you agree with that technical outlook? Do you disagree? Comment in the section down in the comment section below, especially if you disagree. Like, what are you seeing that suggests why you might either be a lot more bullish than I am or a lot more bearish? So share whatever chart or technical indicator or ratio or you know, whatever economic indicator, whatever it is that's driving that opinion of yours. Share with our community down below. All right, now let's talk about what's driving this price action here. And let's just take a look. Again, you can see the strength in equity, small caps, Qs, and EEM, all just, you know, and even commodities showing some showing some strong 3-month returns relative to U.S. equities, and developed markets also kind of matching U.S. equities too. Along with the dollar continues to really show weakness, and that's doing this nice little breakout, and more of a breakout in these metals, especially silver and gold. And that I tweeted out this chart of the ratio between silver and gold here. Let me bring this over here. Sorry, let me bring it back over here and refresh that chart. You can see the nice breakout pattern that we're getting. Look at the RSI jumping up to 70. I mean, it hasn't been above 60 except for a brief period of time here. Back on this run in 2016, big, nice, long run, you know, that we're getting. In fact, the last time it was kind of this coming off of the 2009 lows, where we went all the way up to 2011. So nice little run on equities there during that period. You can see the PPO is finally turning positive. So the 50-day moving average is really close. 10-week moving average, excuse me, is really close. The crossing over the 40-week. In fact, that's the simple moving averages. If we actually use the exponential, which is here, pull up the exponential there and the exponential here. Oops, not 20, it'd be 10 and 40. 10 and 40. There we go. So you can see we do have the crossover there, and that's where the PPO is showing that crossover to that point. So good, strong move across and potential. I mean, we've been on a downward trend on silver versus gold for literally for years, and that hasn't stopped the market from going up. And you can see during this bullish market run, you know, silver really outpaced gold coming off of that recession. This is a recession. And of course, this is a big recession when silver really comes in below gold. So again, it kind of underlies the fact that we've probably been a bigger recession than we think we have been, considering how bearish this has been. And you can see back in the late 90s, we also had a good long, pretty decent run here a couple of times on silver relative to gold. So it's a good pattern from a risk appetite standpoint and a very strong breakout. So we'll see how this continues going forward from here. A lot of this strength is from overall risk appetite as a whole, But again, it's another function of what we're seeing in the U.S. dollar, the weakness in the U.S. dollar. I mean, here's the Heikin-Ashi candle for the euro relative to the U.S. dollar. You can see, I mean, if I were to go back and to give you some context here on where this PPO is right now, I mean, it's relatively low. Like, you know, when we've been bullish, especially over here during that same time frame that we talked about before, where silver really outpaced gold, and then going into this recession here, the PPO was a lot higher than 1 for most of that period. So it's weakness in the dollar is kind of and its strength and risk appetite combined that's making silver outpace. Otherwise, if the dollar was weak and risk appetite was weak, you'd see gold really showing off. But you got this breakout in the euro, a nice good Heikin-Ashi candle. It's actually closing above like all of these highs, including this one, 114.83. We're closing at 14.97 right now. We got a couple more days left, but I mean, you can't have a more bullish breakout on the euro than that, which again is bearish for the U.S. dollar. What we don't see quite yet is a breakout on yields. In fact, yields continue to be pretty bearish. So again, you know, if we're looking for tailwinds on what could really drive long-term returns over the next year, year and a half, you still have the unwinding of this long-term treasury that is just extremely bullish, right? If you go linear regression and go into a 10-year chart here, and we'll just go to like a weekly chart. Go to a 10-year weekly chart and you pull up the ETF for long-term treasuries, you see just how still strongly bullish we are. Hardly overbought in the least bit. Like when we were hitting that peak in October of 2018 before we had that fourth quarter decline, bonds were pretty oversold at that point. And now they made such a good move. So you think, man, it's crazy how bonds can be so bullish during a bullish market that we've been in for the last couple of years. But again, it's the Qs kind of masking a semi-bear market that we've been in. But this unwinding and again, I show you gold, but it's not just gold here. And gold, so look how strongly bullish that is. It's really breaking out here. But that's not a safety trade ready to unwind like bonds. So you have to look at gold relative to other risk assets, and that's where this comes in. And you can see there is a pretty healthy unwind still. I mean, look, these low points over here, we're still below that 12.5% or 1.25% mark here. We're still well below that. The high is up here in the 2% plus range. So we got a long ways to go even here in terms of gold unwinding, not on an absolute basis, but on a relative basis. In this case, relative to an industrial metal that's more a reflection of economic expectations rather than safe haven expectations. All right, now let's take a look at how the sectors are performing, and this has been the interesting note. You can see the cyclical area is still very strong. Materials also kind of joining. That's the gold element there. You can see industrials, financials lagging behind, though industrials are doing better. It's that weakness in the dollar. Energy trying to recover. It's just not able to get some good momentum going forward here. Again, just looking at how things performed today. So let's go into first just today, and then we'll look at the week. I mean, look at utilities and real estate. Those are your big winners today. So not exactly the most risk-on day. And you also have industrials and healthcare doing well, staples up there, and discretionary. So consumers, technology holding up, the communication services, financials, and energy just really lagging. And that's just today. So if I were to go back to the beginning of the week, energy is giving back some. That's why it was so weak. It had such strong gains yesterday, big gains. So giving back some of them. Still the most bullish for the week that was. And then you have your discretionary and technology named, your cyclical areas, which you expect them to be bullish. They started the week strong, along with communication services. It's kind of pulled back here with its weakness today. And then you have real estate and utilities, which were the biggest losers going into today, and you can see why they've bounced a little bit. They're still the weakest performers for the week, and you can see some of these other areas. So, you know, we've on a day-to-day, on a one-day basis here, a couple-day basis there, you'll have financials and industrials kind of leading the way up, and there'll be a lot of chatter about, you know, an energy, and you know, a lot of chatter about, you know, shift into values again, or but for the most part, you know, you still have strong momentum in the growth areas, and that's going to be hard to shake in terms of, you know, it's not going to change the trend in the matter of just a week or two. When you look at this relative rotation graph, you can see here's large cap value, still a pretty significant underperformer. And here's small cap and mid cap values, which have been doing well, but they're still on the wrong end of the relative, even with strong momentum lately, and the strongest momentum, along with just value as a whole. Here's the, excuse me, this would be the small cap, excuse me, this would be, where is it? There we go. This is the small cap, and this is the small cap value. I mean, they've got the strongest momentum, but they're not crossing the 100 line on relative strength here anytime soon. Whereas, you know, we're losing some momentum in U.S. growth and large cap stocks and large cap growth, along with small and mid cap growth. You know, you're losing momentum there, but they're all still on the right side of the 100% mark, which means while they might be losing momentum, they still have relative strength compared to the value peers. So, you know, we'll get some, you know, some change in leadership for a day or two, but as you can see, you know, from a sector rotation standpoint, you can see where the leaders still are and where they continue to be, and right. And if we get weakness in these cyclical areas, and you know, some of these other areas really kind of take off, then it's probably not going to be the most bullish until the end, right? Until we get closer towards the end of a mature long-term run, then you'll start to see some relative weakness in these areas. Then you'll be like, okay, you know, we're going to have a shift here, but until the shift, we'll take advantage of strength in these new leadership, and we'll ride that value as long as it takes us until, and again, that value will hold better on any kind of long-term pullbacks because, you know, better margins of safety with their underperformance during during the run higher. So you can see energy, real estate, utilities at least is up above its moving average, so it's yellow, and industrials and financials also above yellow moving averages. So, you know, you've got dark green shading and green lines in healthcare, materials, which is gold, and obviously healthcare, and then the cyclical areas. That's where the strength is, and it continues to be. That doesn't mean you can't trade stocks that are like in those sectors. For example, for today's trade idea, we'll look at a stock in that industrial area like Caterpillar, right? Caterpillar's looking pretty strong. It's got, you know, a good bullish market forecast pattern. It's got 3 green arrows. Here we go. It has 3 green arrows here. Eventually, there we go. Well, it's 1 red arrow, but just barely. It's got a nice, good trend going. If you look at some of these other oscillators here, now it is above 60, but you see for the most part, even during this rally, it's every time it's gotten above 60, it's come right back down. So, and it's got this upward bias, but it's not really able to get going and trend to the upside, and you can kind of see a little bit of divergence even setting up down there. And then you look at the DMI and take a look at Caterpillar and the DMI. Again, very, you know, the ADX is not as low, but it's not quite able to get going either. And you see the positive, you got a bullish pattern here on the directional indexes, the positive and the negative. But what really stands out here is this Bollinger Band chart. And you can see you've got this huge volume node above the value area. Usually above the value area, if you have any volume to the upside, it's very light, like right about here. And you get above that, you break out above the value area, you've got path of least resistance to the upside. And we can really take off and trend higher. Not the case for Caterpillar. You break above the value area, you probably have as big a volume node as you do at the point of control, which is the biggest volume area for the whole year in this case. So that's a pretty significant resistance. And of course, you got a lot of resistance down below us at the point of control, as well as another volume node right below that. So it's going to really, with earnings coming up, it's going to be really hard for the stock to get any kind of thing going to the upside or to the downside. Doesn't mean we can't break resistance. Doesn't mean we can't break support. But the odds are lower because you expect resistance to hold until it doesn't. You expect support to hold until it doesn't. So that sets us up, especially with this earnings coming up, for an opportunity to do an iron condor trade. So let me pull up Caterpillar. Let's take a look at the trade that we did here. We sold the 125 and bought the 120 put vertical. We sold the 150 and bought the 155 call vertical. So in other words, as long as it stays kind of right here in the middle, we make our money, and we're right in the sweet spot right now. Or if we got a full position size, even with the earnings, because we know we got strong resistance and support on both sides, and a big volume node in this area anyway to help kind of with the gravitational pull to keep it in this area. And you can see where the risk is. So these dotted lines are our break evens. They are listed here on the on this chart. They're the blue lines. So those blue lines, let me go ahead and get rid of this. Get rid of this one too while we're at it. These are our break even. So you see how much room we have to the upside and how much room we have to the downside, and some pretty decent resistance up here and pretty decent support in this area to hold us in this neutral zone. So we'll make a neutral trade, a high probability neutral trade, and make a few $100 for the $1,000 of risk that we're putting on the table. Of course, we don't want to risk. We don't want to lose $1,000 or $1,100. So the most I want to lose, since I'm trying to make $390, the most I want to lose is $390. So once my P&L shows a loss of $390 and we're out of here, but you notice like it takes a move like right now all the way down here to get that on the downside, and it would take a move all the way up to about right here. To the upside. So that's how much room I have to work with on the stock. Very, nice, high probability trades, decent risk, but we can manage that risk a lot easier than some of these other more directional short premium trades. And we don't want to be too directional, even on our short premium trades, like with short put verticals or long call verticals, because of that risk factor that we have coming up here. So we have a really good trade to the upside and downside to take advantage of it. Alright, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on our website at marketscholars.com. You can open up any new thread with any questions or comments you have. You can reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video below, follow me on Twitter for more content between the videos, and join our community at marketscholars.com as well as our Facebook group. Have a great rest of your Wednesday night, everybody. Thanks again for watching, and we'll see you all next time.